you can pay nothing for cryptocurrency taxes. And there's actually a variety of ways to be able to do that. I'm going to explain more in this video. Before I do, special shout out thank you to our Patreon supporters. A double shout out thank you to RemAG for being a higher tiered supporter. There's a link in the description if you'd like to check that out. And also, please keep in mind that I'm not a financial advisor. This is not financial advice. This is my own research. This is my own opinion. I encourage you guys to go do your own research. I encourage you guys to double check with the CPA on this stuff. But I've known about some of the stuff that's inside of this video. I compiled more doing my research, finding out from other resources as well, and presenting everything hopefully into one nice, convenient-based package video for you. Okay, so with that being said, let's go ahead and get on into this. We have a list. This is identifying 11 countries through Decrypt. I will include a link in the description for you guys so you can go check that out for yourself. These countries that don't have tax Bitcoin gains are Belarus, Germany, Hong Kong, El Salvador, Malaysia, Malta, Portugal, Singapore, Slovenia, Switzerland, and Bermuda. Now, in addition to these, one that's been commonly talked about is Puerto Rico. So this describes it very well. Why is Puerto Rico a tax haven? This is primarily due to the fact that United States citizens who live in Puerto Rico, spending at least 183 days a year there, are not required to pay U.S. federal tax on income and capital gains. So if you trade cryptocurrencies in the United States, at least, it's considered as a capital gains. So this is saying like, hey, it's kind of an easy transitionary movement over to Puerto Rico. And so it was also elaborated, can you just move to Puerto Rico? Well, if you're an American citizen, this makes for an easy transition to the island because you won't need any work permits or visas if you decide to relocate. In other words, living in Puerto Rico is almost like living abroad, but without either the paperwork hassle or immigration concerns. In addition to that, let's go ahead and take a look at, for example, Portugal. So Portugal also has 183 days where you need to be residing there. The Portuguese tax authorities are quoted as saying that an exchange of cryptocurrency for real currency constitutes an on-demand, VAT-free exercise of services. This means that any profit from the purchase and sale of cryptocurrency in Portugal will not be taxed, nor will the exchange of cryptocurrency for other currencies. The authorities have also clarified that no income tax must be paid by individuals who receive payments in cryptocurrency. However, companies registered in Portugal dealing in cryptocurrency are taxed on capital gains between 28% and 35%. Okay, so again, just to kind of elaborate, it looks like you're fine if you're an individual. If you're a company doing stuff with cryptocurrencies, well, then you're starting to go down that side where there are more taxable-based events, the capital gains format, okay? Now, if you live in the United States and you're saying, I don't want to move to another country, this is how it works. You have federal and state taxes. So what we're looking at right now is based on the federal level. So it doesn't matter what state you live in. This is just part of the United States for its format, okay? What is listed under the ordinary income tax rate is based on a short time frame, okay? So if you buy, let's say, Bitcoin today and you sell Bitcoin anytime between now and before a year, that would be constituted under the ordinary income tax rate. You can see the different price levels that are listed there. And now if you have it in excess of 1 year, then it would fall into the category of the capital gains tax rate you see in the yellow bar section. I'll go ahead and move my webcam so you can see for both the individual side as well as for if you're married filing jointly. Now, in addition to that, there are certain states, because remember, we just talked about the federal level, but the state level, that there are different tax rates. So you actually have to combine these together, and that's where things get so messy. If you take a look at California, California is the worst because you have the federal income tax, or sorry, capital gains tax, and then you also have its own state tax, and it gets to be very costly. But if you're looking for the best states, these are the best states that you could consider moving into, as they don't have any state capital gains tax. You still have to pay the federal, but there's at least no capital gains for the state. Those being Alaska, Florida, New Hampshire, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. And you can see those illustrated on this map right here, and they are the locations in green. I'll give you guys a second there. All right, I think that should be good. Let's go ahead. You can always pause this video. We're going to go ahead and move on to the next display chart here. So this just kind of further elaborates what we talked about. You can see when you do all the combinations just what kind of the worst locations are, and California stands out at the top there. You've got Oregon that's not so good, and it just gives you a little bit of a better visual, but we just covered that. Now, something else for you to keep in mind are crypto IRAs. An example of a company you can work through with this would be Charitable. So while both traditional and Roth crypto IRAs offer tax benefits, the timing of receiving the tax benefits varies. A traditional crypto IRA offers more immediate tax benefits since crypto contributions are tax deductible and you defer paying taxes until you access the funds when you retire. Okay? That's a traditional crypto IRA. Contributions to a Roth crypto IRA, let's really highlight that one. Roth crypto IRA, on the other hand, are not tax deductible. However, you receive greater tax benefits down the road by avoiding paying the capital gains tax on any increases in value when you do access the funds. And moving on past that, we also have crypto lending. So a couple examples would be, for example, BlockFi, Celsius Network. I actually use BlockFi. I'm an affiliate with them. I've been using BlockFi for a while now. I got my own money that's over there. So me personally, I trust it, at least, you know, with everything I know as of the time of this video. But there's a referral link. So if you guys are not part of BlockFi, you can check out the link in the description and get yourself set up there. They probably have a sign-up bonus. It sometimes changes per the months. Crypto lending. So this would be an example where you're putting up collateral in order to receive money on hand. There's a benefit that's there. You're not actually selling the cryptocurrency, but you're still getting money. You still have to pay off a debt, but check this out. Receiving money for depositing cryptocurrency as collateral is not a taxable event. It's like getting an equity line of credit in which you collateralize your house in the bank and get money against the appraised value of the property. Spending the money received is also not a taxable event. You can spend your money on anything you want. Anything you want, right? You're going to pay for your rent. You're going to buy a car. You're taking your girlfriend out to dinner. However, remember that if you don't pay the loan, it will lead to a taxable event. Crypto lending platforms impose an annual interest rate for lending money against your cryptocurrency. This rate is around 5%. It's going to be different for different exchanges, and that tends to fluctuate also during the course of the year when you get yourself set up with all of that. As far as like the interest rewards go, tax interest charges may be waived if you use the loan income for business or investment purposes. So you got a variety of options. They're popping up right here. We just got a little bit more. So something else you could take into consideration is tax loss harvesting. Tax loss harvesting is an investment strategy that maximizes after-tax returns by taking advantage of dips in cryptocurrency market prices. Imagine if you could appreciate wealth over time while in the process increase your tax refund, or at a minimum, reduce what you may owe in taxes. Tax loss harvesting does exactly that. There's a couple things to keep in mind with this. Some of the risks that you have are transaction fees. So if you're using an exchange, that exchange is probably going to have some sort of a transaction fee when you go to buy or sell. So if you're doing this a lot, not only are you paying percentages because of your actual taxes you have to pay to the government, but in addition, the platform itself, as part of its operating system, is incurring transaction fees there. Something else to keep in mind is that if you sell at a loss, you re-enter into a lower position, your gains could potentially end up being bigger in that longer run or even shorter time frame, depending on when you're doing this. And so that could mean that you actually end up with higher capital gains because you made a bigger yield profit. Something you can take note of this, you can harvest losses to offset gains as well as up to $3,000 in non-investment income. According to the wash sale rule, this is important, when you harvest losses, you cannot repurchase substantially identical investments for 30 days. Tax loss harvesting only applies to taxable investment accounts, not retirement accounts. And the last little bit that I want to share with you for you to keep in mind is what's called a charitable remainder trust. It's also known as a CRT. This is a gift of cash or other property to an irrevocable trust. The donor receives an income stream from the trust for a term of years or for life, and the named charity receives the remaining trust assets at the end of the trust term. So basically, you pass away, and then based on when you passed away where you wanted this money to go for the charity, whatever the assets are will be given over to them. So in the meantime, you have an income that's coming towards you progressively. It's on a continuous basis. You could, look, this provides tax deductions for you for about 5 years. And it's a different rate that goes through for those different 5 years. But this is definitely an alternative option that you could look at to reducing down your capital gains fees, right? So I gave you some different options in being able to not have any fees, and then I gave you a couple more options to be able to reduce them down. I hope this video was helpful for you. Let me know your guys' thoughts in the comments down below, and I do have referral links in the description for free crypto, free stock. Again, I am not a financial advisor. This is not financial advice, guys. And if you're new to the channel, don't forget to hit subscribe, hit the thumbs up like button. It does help us out with the YouTube search algorithm. Click the bell icon so you know whenever we have a new video, and I will see you in the next episode.